everyone. In August, the Ministry of Finance notified the Foreign Exchange Management Rules 2024, amending certain provisions of the Foreign Exchange Management Rules 2019, which govern FDI norms in India and has now relaxed cross-border share swap provisions, thereby allowing issue or transfer of equity instruments of Indian company in exchange for foreign company equity capital, which was earlier permitted only with the prior approval of the Reserve Bank of India. So, to understand this amendment better, we have an expert with us. We have Ramya Hariharan. She's founder of Citadel Law Chambers. Welcome, Ramya.
Thank you. Thank you so much, Avni.
So to start the video, and to make our audience understand these provisions better, I wanted to start with like if you can provide a quick insight into the key amendments made in the non-debt instrument rules recently.
Sure. Thanks, Avni, once again. On August 16, 2024, the Ministry of Finance, Department of Economic Affairs introduced several changes to the non-debt instrument, or rather the foreign exchange management non-debt instrument rules. This was, of course, a part of the budgetary mandate where the finance minister had committed to streamline the foreign direct investment rules and the overseas direct investment rules. So, as a part of this commitment, certain key changes were introduced pursuant to the amendment rules. The first amendment, of course, was simplifying cross-border swaps. Second, I will be discussing about these amendments in detail. First, I would just like to give a quick insight into the various changes that have been introduced. The second change that was introduced was in connection with the definition of control. So the definition of control now has been aligned with that of the Companies Act. Even before the amendment, it was more or less in lines with the Companies Act, except for the fact that persons acting in concert and direct indirect control was not part of the definition. So now, so that there is a uniform interpretation of the terminology of control, this amendment has been introduced by the Ministry of Finance. The third change that has been introduced is with respect to the definition of a startup. So the startup's definition had undergone a change pursuant to the government notification of February 2019. However, the NDI rules continue to uh, retain reference to the old notification of 2016. So this change has also been introduced to remove this anomaly and to harmonize the interpretation of startups across all statutes. So now, even for the purposes of FDI, a startup recognition would continue for 10 years as long as the turnover does not go beyond 100 crores. The change that has been introduced is with respect to white label ATM operators. Now, in this sector, 100% FDI has been allowed under the auto route. Again, another significant change, or maybe more in the sense of alignment, which has been brought in, is with respect to overseas citizens of India. The law now provides that if an overseas Indian citizen of India is making a investment in an Indian entity on a non-repatriation basis, then the same would not be considered for computation of indirect foreign investment. So these are some of the significant changes introduced by the amendment rules of August 2024.
Okay. Now these rules have come in. So, what Indian companies should be mindful of when engaging in share swaps with foreign companies under the new amendments?
Yeah, so these new amendments are undoubtedly very beneficial for, M&A and restructuring activity, and I'm sure we would see a lot of transactions happening soon. However, certain points to be kept in mind. First is that, although Rule 9A has been introduced and Schedule 1 has been amended, at the same time, the amendment also clearly says that if there are any central government or government approvals required, they continue. So just because cross-border swaps has been allowed does not mean that the sectoral conditionalities don't apply. So if a sector falls under government route, then the government approval will nonetheless be required. Second is that if the transaction is with a entity which is a resident of a country which shares land borders with India, then again government approval will be required. Or if such entity has a beneficial owner who is again a resident of a country having land border with India, then also central government approval would be required. Second point to be noted is that under the overseas investment rules, LLPs in Indian entity is defined to mean both company and an LLP. However, the FDI amendments only cover Indian company. So the liberalization of cross-border swaps is still not available to LLPs as of now. The third thing that is to be noted is that insofar as foreign owned Indian companies are concerned, owned and controlled companies are concerned, what the law still continues to state that such investments have to be done either through funds brought from outside the country or through internal accruals. So whether cross-border swaps are permissible in such a situation still remains ambiguous. There is no clarity in this regard. Another point to be noted is that, although cross-border swaps have been liberalized from a foreign exchange angle, the tax implications still have to be considered. So there could be a situation where you are getting shares in exchange. So there is no actual consideration, as in monetary consideration flowing between the parties. However, the entity would still be subject to tax. So taxation is also another point which should be borne in mind while looking at these structures. Another point to be noted is that, Schedule 3 of the Overseas Investment Rules allows swaps of securities in case of a resident Indian individual or rather a resident individual only in case of mergers, demergers, amalgamations, and liquidation. In any other circumstance, a resident individual cannot make overseas investment by swapping either their existing domestic investment or their overseas investment. So a resident, unlike an Indian company, a resident individual does not have the same advantage, okay, insofar as cross-border swaps are concerned. So this is also a point to be kept in mind, where the investor or person investing is not a company but an individual.
Thank you so
Thanks.
much for sharing all these changes. It gives a quick insight into what all were the key amendments. But let's go, let's cover each one of them one by one. But before that, if you can help us understand what are the key benefits for Indian companies from this new simplified cross-border share swap rules, and how will this help in their globalization and enable them to reach new markets?
One of the significant changes introduced by the Foreign Exchange Management Non-Debt Instruments Fourth Amendment of August 16, 2024 is the simplification of cross-border swaps. Before we delve into the details of the changes introduced, it would be useful to discuss the legal landscape that existed with respect to swaps prior to the amendment. Swaps were contemplated under the extant foreign exchange regulations. However, such swaps were restricted to swap of equity instruments. Equity instruments are defined as equity shares, convertible debentures, preference shares, and share warrants issued by an Indian company. The extant regulations allowed a non-resident to transfer shares held by it in an Indian company to a resident, and an Indian company could issue its shares to a non-resident against swap of equity instrument. Thus, what was not allowed was issue transfer of shares of an Indian company in exchange for shares of a foreign company. Whereas under the overseas investment rules, an Indian company or an Indian entity could make overseas investments against swap of securities. Thus, an Indian company could acquire shares of a foreign company in lieu of its own shares or shares of another Indian company held by it. This discrepancy has now been plugged through the amendments. Swap of foreign equity is now permitted pursuant to insertion of Rule 9A and also pursuant to the amendments made to Schedule 1 of the NDI rules. In simple terms, what does the amended NDI rules now allow? One, a resident holding equity instruments in an Indian company can transfer such instruments to a non-resident in exchange for equity instruments held by such non-resident in an Indian company. Second, a non-resident holding equity instruments in an Indian company can transfer such instruments to a resident in exchange for equity instruments held by the resident in another Indian company. Third, a resident holding equity instruments in an Indian company can transfer such instruments to a non-resident in exchange for the foreign equity held by such non-resident. Fourthly, a non-resident holding equity instruments in an Indian company can transfer such instruments to a resident in lieu of any foreign equity capital held by a resident. Thus, Indian companies now can acquire a foreign company by way of share swap, such that the foreign company becomes a subsidiary of the Indian company and shareholders of the foreign company become shareholders of the Indian company. This can be achieved either by way of primary swap, that is, by issuance of fresh shares, or by way of secondary swap, that is, by way of exchanging shares held by the Indian company in other companies. This change will definitely facilitate cross-border share swaps for Indian companies and may result in more businesses opting for reverse flipping, which is already seeing a lot of activity, positive action. Foreign company acquiring an Indian company by way of a share swap is also now permitted under the amended regulations. So a foreign company can acquire an Indian company by way of a share swap such that the Indian company becomes a subsidiary of the foreign company and the shareholders of the Indian company become shareholders of the foreign company. These amendments thus enable Indian companies to expand their global footprint through M&A and other strategic activities. We will definitely see a lot of cross-border activities and M&A activities in the near future. However, a point to note is that the SEBI regulations relating to preferential allotment allow preferential allotment only against swap of shares of an Indian company. Therefore, till such time, the SEBI regulations are amended to allow swap of foreign shares. Listed companies may not be able to acquire a foreign company or a foreign entity since the listed company cannot, or a listed Indian company cannot offer foreign shareholders its freshly issued shares as payment for foreign shareholders shareholding in such offshore company.
Thank you so much for sharing that. It gives a better understanding of what these new swap rules are about. In the first answer, you mentioned that 100% FDIs are now allowed under white label ATM operations. And coming back to that answer of yours, are there any conditionalities attached with this 100% FDI which is allowed under white label ATM operations?
Yeah. So 100% FDI has been allowed in white label ATM operations to increase financial inclusion and to increase rural outreach so that banking services are also available till the last mile, which is generally ignored. And the intent behind introducing 100% FDI under the auto rule is to ensure that, foreign investment comes in. So more and more rural areas also get, or the underserved areas also get served better. White label ATM operations, as the name suggests, basically means ATMs which are owned by non-bank entities. So the auto route investment comes with certain conditions involved. One of them being that there is a minimum net worth requirement of at least 100 crores as per the latest audited balance sheet. Okay, latest fine audited balance sheet of the latest financial year. The second requirement is that if the company falls or the entity falls under other financial services, then such entity would also have to comply with the minimum capitalization norms, if any. The third requirement is that the entity would also have to satisfy or comply with the regulations specified by the Reserve Bank of India in the Payment and Settlement Rules of 2007.
Thank you. Thank you for sharing that. Coming to my next question, can you explain how excluding NRI and OCI non-repatriation investments from being counted as foreign investments affect Indian companies?
Sure. So I must actually, mention here that the intent of the FDI or non-debt instrument rules has always been that when an NRI or an OCI invests in a non-repatriation basis, it should be treated as domestic investment. However, for a foreign-owned Indian, so if it's a domestic investment, then obviously a downstream investment should also be their investment while computing downstream investment calculation, while computing indirect foreign investment for a downstream investment calculation should be treated as domestic. The law was not very clear on this. All that the amendment has done is basically to clarify that since the original investment is domestic, so even from the downstream investment angle also, it would be treated as domestic and should not be counted while computing indirect foreign investment.
Thank you so much for sharing all that, Ramya. I hope this will give our audience a better understanding of this new amendments and not just the key benefits, but also what they should be mindful of when engaging in this share swaps. Thank you once again. If anybody have any more questions, please comment below, and we will get back to you. Thank you so much.
Thank you.